On today's show, 3 questions. Number 1, why is the stock market disappearing? Number 2, when do you think you'll retire? And number 3, what are historical returns? And number 3, what are historical stock market returns? Welcome to Dentist Money's 2 cents, where we help dentists navigate all the noise. I'm Matt.
I'm Jake.
And I'm Rabih.
Hey guys, how are you?
Hello.
Great. How are you?
Rabih was so prepared for me to do something, and I didn't, which actually was my strategy, because then you were so ready for me to do something, say something to throw you off, and I didn't, which was my strategy, and it worked. No matter what I do now, you're like waiting. You're like, what's he going to do? So anyway, full disclosure, this is, we're just going to tell everyone behind the scenes, this is our second of the day. We're going to do this preemptively because, Rob, you want to let the good people know why we're doing this?
I like to do miserable stuff to myself, and I signed up for an intensive course as part of my graduate degree, so I won't be in office. So we thought, let's not take the fun out of people's day. I know there are a lot of podcast fans, so we decided to record one ahead of time.
Yeah, let me rephrase that. Rabih loves to learn, and he's brilliant, and he is just continuing to do that with his intensive course. So we thought we would just do this again, or do this twice, and then we'll just release them 2 weeks in a row. So anyway, always good to be here. Let's start, Rabih, with, this is one of the more provocative questions that we've had in a while. Why is the stock market disappearing?
I don't say this is scary. That's a scary title.
It's very scary.
Yeah, I'm taking a break from like what happened this week and what did the Fed say and which Fed official gossiped on the other. Like we're taking a break from these stuff, and we're gonna talk about a little bit of a macro topic. I still remember it since I was like a freshman in undergrad when a lot of my professors kept talking about the stock market is shrinking in size. Like we had back in the days, we had an index in the US called the Wilshire 5000, which talked about all 5,000 stocks in the US market. And now if you look at how many stocks actually exist, US stocks in the stock market, that number dropped down to 3,800, 3,600. So the number of publicly available companies traded on exchanges has actually been dropping in the US. And there are multiple factors for it. And I found this article from The Economist, and I just took the reason the title is provocative, I just stole their title in a sense. The provocation over here is like, I plagiarized. I stole their...
The question is, why did Rabih steal the title of this article?
It was too good. Yeah. So I'll give them credit, and I'm just going to use the title of their article. I can send the link to the article to whoever requests it. It's like, why is the stock market disappearing? And they mainly talk about private equity. So let me just walk you through the article, give you some talking points from it, and then we can discuss. So the article starts with discussing the idea of supply and demand and how usually when we are occupied by tracking the market and seeing performance, we're only looking at the demand. If demand is high, people are buying, the stock market is going up. If the stock market is crashing, it means that people are selling, and then the demand is low for stocks. However, there is another side that determines stock prices and determine like the functioning of the market as a whole, which is the supply side. We do not really see a lot of activity on the supply in the stock market, simply because once a company goes public and they issue their shares, the number of shares outstanding that exists for people to trade, the supply side of the market, is kind of constant. It's not varying a lot of time. And empirically, there are only like 2 main scenarios we're most familiar with when the supply side of the stock market or the number of stocks available to trade change. One is when earnings seasons happen and companies decide to issue dividends. Some of them decide to do a share buyback, aka the company itself decides to remove some of number of shares outstanding from the stock market, thus dropping down the available quantity, aka removing supply, and thus pumping the stock price up as a form of dividend, tax efficient dividend to investors. So
this was a huge controversial topic during COVID, the stock buyback. This was like top of the discussion boards and Twitter and all this stuff where stock buybacks. It's since died down, but this was like number one controversial topic for a couple of years.
Yeah, and honestly, the way we can think of it is just a way a company can provide its investors with a more tax efficient dividend. Because once you buy back shares, you're definitely pumping the price up. And in a sense, you're giving the investor money. You can either give the investor money in the form of dividends, where they have to pay ordinary income taxes on them when they get received, or you just pump up the price through a share buyback, and it's now up to the investor to decide when to sell and realize the gain to pay the taxes. So it's just a different tool in the market. The other way we can increase supply in the market, or decrease supply, mainly increase, is when a company actually goes public, does an IPO, and all those internal shareholders, insiders, sell their shares to the public, and now it's available for trading. The activity of number of IPOs have kind of a little bit slowed down, but also a lot of companies have been delisted, and the amount of new companies added to stock exchanges hasn't been as high as the number of companies not showing up on exchanges, and that's why the stock market has been shrinking. So let's just dive in a little bit into details on explanations for why there has been this misbalance, and why the number of stocks available in stock markets have been dwindling down.
Hey, Rabih, sorry,
Yes.
Really quick, before you go into the reasons, does it talk about, or do you know, can you give us context of when we say it's shrinking, what does that mean? Like what are the actual numbers to that?
That's a really good question, because like when you think of shrinking, what do you mean? It's like people are not trading, or it's like not enough companies. It's interesting. What we're saying is what's the number of companies on stock exchanges? The number of companies have been dropping. You had 5,000 companies to play with. Now you only have 3,600 companies to play with. However, what's the trading activity like between those 3,600? Are they really moving around between investors a lot? Is there a high volume, low volume, day trading, people buying derivatives on top of them? This has been increasing every single year. So the number of stocks available is like companies, separate companies, is lower, but the activity of trading those companies that are left on the exchange is at an all-time high, and it keeps increasing every single year.
And I assume the assumption would be, even with these 3,600 companies, the total market cap of all of these companies combined is still probably greater than what it was 20 years ago, would be my guess, right?
Oh, yes. Yeah, because the market...
By far, yeah.
So we're having less companies, but they're all worth more, and trading activity is still really high and growing.
Exactly. 100%. This conversation is limited to the ideas like number of companies available on exchanges.
Got it.
This does not talk about the returns. This does not talk about, the trading activity, liquidity in the market, none of that. So,
thanks for going through that.
No, sure. So part of the reasons for why this has been happening actually stems from the private equity market. And when we're talking about private equity market, especially venture capital, we're talking about companies that are small. They received funding from, angel investors and investors in early stages in seed rounds, like round 1, 2, or 3, depending on key metrics a company makes, whether it's became profitable, they already have revenue, they were able to, what's the word they really like to use? Like dramatically change disrupt industries. They're able to disrupt industries.
Disruption,
those vocab that venture capital firms like to use. So based on these milestones, they would receive more funding, and at the end, those private investors would all cash out by listing the company publicly on exchanges. So the first reason is that now entrepreneurs, founders of those smaller companies, actually have more options than they used to. They not only can they just go to the market, to public markets, do an IPO to raise money for their business and execute on projects, they also have the option of too many private investors competing amongst each other, that if that entrepreneur wants, they can keep their company private and still access this line of funding that a public market would have offered. So that is number one. There are more options. The second one is related to the regulatory aspect for having a company listed on a stock exchange. Companies listed on stock exchange are actually under the governance of the exchange itself and the SEC, and they have very strict requirements to protect the end investor. One of these strict requirements is a lot of disclosure and transparency, because at the end of the day, the retail investor buying a stock on the exchange, they have the right to know about the company as like any other investor, because they don't need to know about the private project, about the, I would say, the key differentiators of this company and what makes them compete and whatnot. So those regulatory pressures actually change the way upper management would want to present the company. The first one, we know that one of the requirements to be on a public exchange is that you have to report earnings every quarter. And this is what all companies do. The fact that a company is now limited to make sure every single quarter their profits and earnings and revenues are trending in the right direction imposes a restriction on them where they have to adopt a short-term thinking. All they care about is that by the end of next quarter, their numbers are looking good. So this is harder, especially for younger companies starting to grow, that are taking a multi-year bet where earnings are not going to show up good numbers for a couple of years. So that is one of the reasons why companies might want not to go onto a stock market just yet, just because their time frame of how projects are going to be done, how they're going to compete in the marketplace, differ from what stock market expectations are. And stock market expectations are usually on a quarterly cadence. That's one. The second one I think was the most interesting in the article is regarded to the overall change in the industrial composition of the US economy and the transparency involved. So back in 50s, 60s, even 70s, most of the largest companies, we're talking about brick and mortar stores, we're talking about oil companies, all of these companies are in industries that are heavy on fixed assets, whether you have a drilling, you have machinery, and most of your competitive advantage comes to like, do you have a store in downtown, or like stuff that are physical that a competitor can't really get right away and develop right away to take your competitive advantage out. However, the current industrial composition of the US economy is tech-based and it's services-based. And when you're a company whose value proposition is that I have a better code, it's hard to be that transparent on stock markets. And when I mean transparent, it's not like they're giving their code out there really quick, but every quarter they'll have to create a press conference, say what they're working on. And if they say, oh, we're working on a code that helps self-driving cars, well, now your competitor knows about it and they can jump on it much quicker than if you're like, oh, we already have the licensing and we're building this great mall in the middle of Manhattan and it's too late for our competitors. So the fact that this transparency makes the competition tougher because competitors get access to you, and just because the economy is now run off technology companies, is another disincentive for companies to go public, because now going public actually threatens their competitive advantage more than it used to a couple of decades ago.
Well, and to that point, Rabih, I'd also imagine that a lot of these companies, more so than ever before, to your point, because of the different industry they're in compared to 50 years ago, it's more based on the idea of something, right? A lot of these companies are just like, this is an idea. We think it could do this, this, or that, but we don't know yet. That's kind of the basis of technology. That's the basis of a lot of these companies, right? And because that dominates the market, I'd imagine that has a little bit to do with this as well. From like an investor standpoint, it's probably harder to pitch that on a public market rather than a private market with seemingly what would be expected to be more sophisticated investors. I'd imagine that's part of this too. Jake, what are your thoughts on this? Or Rabih, go ahead if you have more. Go ahead,
Jake.
I don't know if I really have any thoughts. I mean, it's fascinating. This is bad podcasting to say I don't have any thoughts, but it's fascinating. But I don't know if I have a concrete take, but yeah, interesting for sure.
I'm curious. I'm just curious if kind of I do this a lot, but kind of like the so what of this, right? Because, and that's why I wanted to get some context around what do we really mean when we talk about shrinking outside the provocative headline. What I don't want to have happen is, although, want people to listen, obviously, but we also want to navigate the noise and say, okay, what does this actually mean? If we're talking about market cap, and actually I want to do something, Jake, because I actually think this feeds into your stuff so well. We should just keep this line of thinking going with your topic, and then we can hit my stuff at the end. but I kind of want to hit like the so what, right? What does this actually mean? Someone might hear this and say, oh my gosh, the stock market's shrinking, so maybe it's not a viable asset class anymore. Maybe I should be going into private equity. What are your thoughts on that? Either one of you of like the so what of this? Rabih?
Okay, so when it comes to the stock market, Jake will hit on returns, and we'll get to whether the stock market is still a viable option or not. But when it comes to private equity, we actually have to think of the landscape itself. The reason private equity has taken on this bull market by itself, and it's prompting companies not to go public. The biggest example I can think of is Uber. Uber stayed private for God knows how long, right? It was a long time. They called it the unicorn. It was $1 billion company that stayed private, but at one point Uber became too big and it had to go on the stock exchange. So the idea here, how you and that was during the age of cheap money where interest rates were 0. Now interest rates are 5%. Those private equity funds are usually borrowing to invest in those companies or raising from other investors.
They're highly leveraged.
Most of them would be highly leveraged to be able to support the balance sheet of those bigger private companies that they're buying. So the idea, now we're in a new economic regime where money isn't as cheap, and there is a natural supply restriction on the number of private investors you can access. So at one point, the company will become too big to be able to be contained in a private market, and it would want to go on a public market. The biggest companies in the world are on a public market, not in a private market, right? So what? It just means that now it'll take a little bit more time for companies to reach the exchange, simply because they have better options financing wise. But at the end of the day, they will get there. From an investment perspective, and we've seen this in the market, a more sophisticated investor would allocate a sleeve of their portfolio to private equity just to capture some of these companies. But this doesn't mean they go all in. According to the study in that paper, the average allocation to private equity was around 6% 5 years ago. Now it's around 10% of a portfolio as of 2023, but it's only 10%.
Yeah.
If you're in a 100% equity portfolio, it means 90% of your money is still in public markets and only 10% in private markets, just to like give you the scope of it. And honestly, at the end of the day, how will those private equity investors make their money? They'll have to sell the company to someone else. And it's either going to be sold to other private investors, whom we just said you might run out of, or you'll have to go public, because those private funds, at the end of the day, they need to make their money and they need an exit strategy. And the stock market's still the most viable exit strategy out there.
Yeah, for me, this comes down to a risk tolerance question. If we're talking about private versus public markets and what to invest in, right? Private markets are a little riskier, right? You're getting smaller companies, more unproven companies. You usually have to put your money in. You maybe lock it up for a certain period of time. It is a riskier investment, right?
Yeah.
Illiquidity is a big piece of that. So it is a riskier investment, which, if you want to allocate a portion of your portfolio to that, that could be a viable option. But what we're talking about is less companies are IPOing or going public. That actually makes me think that these companies are now more experienced when they're becoming public. They are more proven. They are the larger companies. They usually have the best leadership teams. And so that would almost lead me to be like, I'm almost trusting of these public companies a little bit more because they've gone through more of a vetting process. And so this just goes back to, risk tolerance. What are you looking for in your investments type of thing there?
Jake made a really good point.
Such a good point.
A big problem of the dot-com bubble in the year 2000 was any company was going on the stock market, whether it was good or not. And now, more trust in the public companies available.
Well, that's a great point, both of you. And if you liken this to the dot-com bubble, Rabih, you just mentioned that a big part of this bull market in private equity, let's be honest, during COVID was significant. It was almost like a dot-com-esque situation, but in the private markets where cost of capital was so cheap. Cost of capital was nothing. And, there's tons of ideas coming out and people are just throwing money everywhere. So I think we kind of saw a similar situation in private equity. I love what Jake just said, like as this kind of flushes out. And I would actually be curious to know if this trend starts to even reverse, over the next few years, now that things have normalized in the monetary system and interest rates have normalized. I would be interested to know if this if this is just remnants of the cost of capital being so low for so long, and if this actually isn't like a long-standing trend. Obviously we have to wait and see, but really interesting. Rabih, what else, if anything, on this that you wanted to, any final thoughts?
I think we covered it all. The only other point from the perspective of regulators, they hit on the thing, but it doesn't really apply because the market is trading at volumes we haven't seen before. It's very efficient. It's, the prices really reflect, but regulators consider the stock market as a barometer for financial stability in the economy and the financial health of the economy. So if they are not traded publicly on markets and prices are changing every single day, it will be harder for regulators to assess the health of the economy, but there will be indices. It's just the same as the examples. Like, we know exactly what's happening in public markets, public equity, but it's right now we have question marks on what's happening in residential real estate, commercial real estate, my bad, right? Because it's not as publicly available information listed on exchanges as it would have been otherwise. So this is just the Sophie's choice from the perspective of regulators.
Yeah. And I guess to sum that up, and what you're mentioning earlier from an allocation perspective of this kind of so what, we believe that private equity can have a place, and in some cases, depending on your situation, should have a place. By the way, investment in your own dental practice and treating it like a business that you should be treating it like is private equity. It is investing 100%. In a private business, right? But even outside of that, we believe that you, depending on your situation, Jake, you mentioned risk tolerance. We'd even say an aspect of like what I'd call your risk capacity, right? Your overall financial situation might lead you to actually have some private equity. We are actually starting to build this out to give actually some more access to things like this for the right people or the right situations. I shouldn't say the right people, the right situations, depending on where you're at. But even to your point, Rabih, 5 to 10% of a total portfolio, we still think that's probably pretty fair. This does not mean go all out, go build your whole portfolio around these private investments. That is not our recommendation. And we don't make recommendations on our podcast anyway. So, all right, Jake, let's jump to you because I think we're going to flip this. I think this actually goes really nicely into your topic.
Yeah, so let's talk about the public markets, and we'll talk specifically about the most popular and famous index in the world, the S&P 500. If you are not familiar, or if you're kind of new to this whole investment landscape, the S&P 500 is an index that's made up of the 500 biggest companies in the United States. These are your Apples, Microsofts, Amazons, all that fun stuff. When your friend is talking about, hey, the stock market did this today, what they're usually referring to is the S&P 500, right? And so when we do a lot of these stock market return data, I think we use the S&P 500 a lot of times just because there's so much data available for it, right? We would advocate for more of a globally diversified portfolio, right? If you're really going to get serious about investing. But anyway, I want to talk about the US stock market today, the S&P 500. I get asked from time to time, I think people just want to know, like, okay, well, what can I expect returns wise, right? What have historical returns been? That expect word is pretty tricky. We can talk about that. Past performance does not guarantee future results. But if we just want to look back, I was just curious today and going through some of these numbers. Let's look back over the past 30 years. Just what has the U.S. stock market or the S&P 500 returned over the past 30 years? So I look back to 1994. Isn't it crazy that 30 years ago is 1994?
Don't even, dude. Don't even. Don't even get me started.
Yeah, that was like, wait, shouldn't it be farther back than that? But no, it's 1994. It's now 30 years ago. And so if we look back, let me break this down by chunks first. So from 1994 to 2004, the S&P 500 had an annual return of 11%, 11.06%. That first decade. From 2004 to 2014, it was 7%, so a little bit lower. Went from 11 to 7, and then from 2014 till now, kind of beginning of 2024, it was 12.4%, so a little bit higher this past decade. If we combine all those together, the aggregate average annual return for the S&P 500 over the past 30 years was 10.06%. Is what you returned. I want to think about this for a second. I want to get into some more numbers, but just think about since 1994, the major world events that we've had. We've had, 5 different presidents, I think now. We have had a dot-com bubble that we've mentioned. We've had 2 50% crashes in the stock market. We have had a housing crisis. We had the great financial crisis. We had wars, I think 3 or 4 different recessions. We had a pandemic that we just barely came out of. Just think about all the crazy stuff that has happened over the past 30 years. And yet the stock market has given you 10% per year on average if you had invested in that. I don't know, that feels like all the turmoil and uncertainty that we've had. 10% per year feels pretty good of like, if we just take into context what have happened over the past 10 years. So I want to give more data behind this before I get some of your reaction. I think some people might think, well, 10% per year, that may seem modest to some. Like, what does that actually do for me? You know, that kind
Who
of
wants
feels
to be average?
Yeah, what does that look like? So if you take 10% per year, that equates to a total return of about almost 1,700%, like total return over the past time. So to put some dollars in this, right? Let's say you had $1,000 in 1994. You put it in the stock market and you just left it there and you just waited for 30 years. Today you'd have $17,700 right now today. So like 17 times your money just by putting an initial investment and waiting right over this time. But most people don't do that, right? I know like most people don't just invest once and forget about it. Most people will say, hey, I'm going to put money in every month. So I wanted to look at that scenario. Well, let's just say you put your money in the S&P 500 January of 1994, and then you did $1,000 a month, just $1,000 a month for the past 30 years. You were consistent, you were diligent, you did it. At the beginning of this year, you would have had $1.97 million by the beginning of 2024. So just $1,000 a month. Just think $1,000. That's it. 1994 to now, 30 years, you were consistent. You grew $1,000 to pretty much $2 million over the course of 30 years. So yes, if we want to answer the question, like, are public markets still a viable asset class? Well, historically speaking, I would say yes. I mean, that's kind of the crazy thing about compound interest is it can take your meager, consistent savings and actually build them to significant wealth. My last note that I want to hear from you guys on this about compound interest and why it's so hard to do this. Did you know if you would have done this $1,000 a month from 1994 till 2014, so 20 years, or you did 20 years of $1,000 a month, your balance was only $550,000 over 20 years. So I think this is why people give up on this a lot, right? It's like, hey, I've been doing $1,000 a month for 20 years. I've a little more than doubled kind of my contributions, what feels good, but it's not like this promised wealth that sometimes people say with investing. But if you would have waited just that extra 10 years, so from 2014 till now, just given it 10 more years, you go from $500,000 to $2 million over those last 10 years.
Yeah, that last third is the magic.
Exactly. So that's the thing where it's like these amounts really do compound and grow, but it is the opposite of the get rich quick, right? It is the get rich slow, take time and patience. But I don't know. I was just going through all this stuff today. I just thought it was interesting. I don't know if you guys have any thoughts about any of that.
I just have to say, I really love all the numbers. I love it when I just like
these eyes are lighting up.
I loved all the numbers, and the eighth wonder of the world is compound interest, and I think this really ties to what we started with and what Jake alluded to, the fact that now the stock market has been selective in who can be there, and it's just selective due to market dynamics. Not every company is willing to be transparent. Not every company is willing to commit to a quarterly cadence of proper reporting. Not every company is actually behind a vision and a mission to actually improve people's lives through their goods and services. Only those select few that make it are going to be of a higher quality, and this is going to be reflected in the return they are showing us and the numbers that Jake mentioned.
Yeah, we can discuss.
Okay, perfect. I love that Rabih's lighting up from the numbers and everything. And I'm sitting here thinking I just literally have like quotes from super smart people, way smarter than me, that are just rattling in my head as you're going through this. The one that comes to mind as I think about this is one of my favorites. I've mentioned this so many times ad nauseum at this point. Is the quote from James Clear when he says that 90% of success is doing the simple and obvious for an uncommon amount of time. And the key there is, Jake, what you said perfectly, the highlight you mentioned there, which was it's the uncommon amount of time. 30 years is a long time.
Yeah.
And we fully acknowledge that. This is why what we preach and talk about is so freaking hard, because doing something for that long and we get this from people like, so is this all it is? Like, this is what we do. We just keep staying disciplined and keep investing and stay diversified and rebalance a portfolio and then just live our life. And we're like, yes, that's what this is. You just have to do it for a long time. It seems so simple and obvious, but it is so hard to do.
Yeah, just think about, again, like I mentioned, think about all of the major world events over the past 30 years, or opportunities to panic or to be scared. And I'm assuming the next 30 years, we're going to have a lot of those as well, right? There's going to be a lot of uncertainty and different changes. But yeah, it's that thing where it is easy to say, very hard to do in practice, right? We kind of equate this to going to the gym and, working out and things like that, where it's like, hey, going to the gym or working out is a very easy sentence to say. But actually doing that for 20 years, waking up every morning and doing it is extremely difficult. And, we always say behavioral coaching is great. Doing this with a buddy is awesome. But yeah, easy to say, hard to do.
Well, and to that point, Jake, really quick, you mentioned all these things that have happened, right? And again, thinking about this concept that Morgan Housel has highlighted so many times of the where you're standing matters, right? So these events that have not happened yet, because there will be more, these events that have not happened yet, to your future self seem like risks. But looking back at all these things, they actually seem like opportunities. And it's all about where you're standing. Now we're looking back and looking what has happened, and we're like, oh my gosh, well, look at what an opportunity for investors that COVID was. Look what an opportunity it was for investors who had a long time horizon that the dot-com bubble was. Like, or all the things that have happened, even 08, 09. What an incredible opportunity that was for people that were investing and had a long time horizon. But it's so hard to keep that perspective, which, to your point, Jake, why we always preach so much having an accountability partner in this, to hopefully keep you in your seat and keep you disciplined and thinking about it from the right perspective.
Just a couple more stats, then we can switch to your topic here, Matt. I just wanted to share of the market's a pretty cool and fun investment. The U.S. stock market was up 80% of the time over the past 30 years. So if you'd invested, some people ask, when is the right time to invest? If we just would have taken an average of the last 30 years, if you would have invested any given year, you had an 80% chance that you're going to have a positive year, right? 80% chance that was going to happen if you invested. The stock market was up 40% of the time, 4 out of 10 years, double digits per year. So 40% of the time, you actually got a double-digit return in the stock market. And we only had 4 years of double-digit drawdowns over the past 30. It's kind of weird to think only 4.
Yeah.
Anyway, the best return was 37%. That was the best year. And the worst year was actually 37%. Funny how that works out.
Yeah, kind of crazy.
2008 was the 37% down. But anyway,
when was the year? Sorry, I'm curious. 2008 was the worst. When was the best? 37%?
I don't know.
Oh,
I didn't see the best one.
I was going to say it's probably 09.
It
right?
probably is.
The recovery.
I guess. Or 10, 9 or 10. Yeah, would be my guess.
I was going to say they're always kind of clumped together there.
Mm-hmm.
Yeah, interesting.
Yeah. Okay.
Awesome. The takeaway here is the stock market is still a very viable and amazing way to build wealth over time. Rabih, any final words on that?
Yeah, I'll say the best way to build wealth.
The best way. I agree. Totally agree.
Awesome. Mm-hmm.
Okay. That was awesome. I loved those two segments and how well they meshed together, and gave a great perspective. We're going to shift gears a little bit as we finish up here, and talk a little bit about retirement. And so the idea of, when do you think you're going to retire? And there's so many different places we can take this. Don't want to spend too much time on this. This is probably a follow-up type discussion as well. But there was a study done pretty recently by the Employee Benefit Research Institute and Greenwald Research Survey. And it was all around retirement. And basically, here's a line to kind of sum this up, and then we can kind of take it from here. It says, workers are chronically overly optimistic about how long they can remain on the job. I thought that summed this up perfectly. And basically it says that while 75% expect of people surveyed, 75% expect to work for pay in some capacity, even into retirement, only 30% of people do. So what this survey basically says is that most people tend to align our retirement age with what society has told us retirement is, which basically is Medicare and Social Security. So 65 has kind of been the age that people have said, but the survey and studies show that the average American actually retires sooner than that by about 3 or 4 years. 61, 62 is about the age. If we're making this specific to dentists, and we can kind of start this conversation from here, the average dentist, according to the ADA, actually retires about 2 to 3 years later than average, and or than the 65, but 7 or 8 years later than the actual average American. So the average dentist retires around 68 or 69, depending on what data you're looking at. So I'm going to leave it here for a second and we'll jump into more stuff. But Jake, you're itching. You've got thoughts on this.
Yeah, I just say like this data really backs up the conversations that I'm having with dentists, right? And almost all, when people come on board and we start working with them, we have what we call like a discovery call where we're trying to figure out goals and what you want out of life and things. And we always ask like, when do you see yourself retiring, right? What are your goals? Do you have an age or something in mind? And most people I talk to say, I don't know if I ever want to retire, right? This is becoming more and more common where it's like, maybe I'll cut down at the practice to a day or two a week, but I always want to maybe sell my practice, but I still want to be working and doing something, which I think is a pretty noble and smart idea. Like, I think, at that point, I'm seeing more of that. However, I do talk with a lot of dentists as well at the same time who are 20 years into their career, right? So maybe they're in their late 40s or early 50s and they're like, I'm done. I am tired.
Yep.
My back hurts. And this is like, I talk to younger dentists who are like, yeah, I want to work till I'm 70. Like, I love this job. This is great. And then I'm talking to these 15, 20 years in dentists who are like, I thought I wanted to work longer, but now actually doing it, I am just kind of tired and I'm really looking for a way out. So yeah, this backs up the conversation I'm having for sure.
Yeah, Rob, I don't know if you have thoughts on that at all.
Jake gave us the two sides of the story, right? And I wonder whether the fact that Americans retire earlier at 62 tells us there are more people who get tired halfway through their career than people who still want to grind because it's their passion.
Yeah.
Yeah,
it's interesting. I think Jake's point is they reference this in the article. A psychologist from University of California, this Hal Hirschfield, mentions this. And Jake, I know you've written about this, but he mentions the gap between expectations and reality and us knowing what we're going to want in the future.
It's the hard part.
We're just not good at it. We just humans, and it makes sense. Like, I have no clue what I'm going to want 30 years from now. I often don't know what I'm going to want tomorrow. So we're just not good at anticipating that. I know there's an actual psychological label for this. Jake, I think you've written about this before. It's alluding.
I knew the word once.
Is it temporal discounting?
That might be
something like that. Where
we're just really bad at knowing what we want, what we're going to want in the future.
Yes.
Right? We just think that who we are today is going to extend in perpetuity for 20 to 30 years, and that couldn't be further from the truth. Right? We're changing all the time.
Yep.
And so it's hard. And if we want to talk specifically for dentists, dentistry is a pretty labor-intensive profession. Right? It is hard, and it takes a lot out of you. You are there day in and day out, and being a business owner, all those things. Like, I just see more often than not that people think they want to work for forever will kind of do it. And some people do, and it's worthwhile. But more often than not, I see people be like, man, this is tough. And I've been doing this for a long time. And so, again, we probably will get to this. Like, my overall fix would be, this is kind of like why we do financial planning, is just we want to plan for a wide range of outcomes, right? We don't need to have an exact date in mind of you're going to retire 64 right on the dot or anything like that. But let's just plan for a wide range of outcomes. Let's save and invest our money. So as each year goes along, we can kind of just update and tweak the plan as we get more details. So kind of be my broad recommendation.
Yeah, because the flip side of this, Jake, is, I don't know about you, but I've had a lot of on the other side of this equation, which meaning when we start working with a dentist, they have like an exact date. They have an exact age. They know, and it's always like 50 or like 55.
Yeah.
And then we start working together and we put a plan in place, and maybe something shifts in their life, for the better. Like maybe they bring on an associate, or they figure out something with their business that takes some pressure off of them, whatever it is. And then after a couple of years, they're like, you know what? I'm in
a good spot.
I'm good. Mm-hmm. I'm feeling good. So to your point though, I think the fix here, quote unquote, the fix, or the answer will always be, from our perspective, is create a wide margin of safety.
Yep.
And that comes from saving, even if you don't have a specific goal, continually investing, having a flexible time frame, having a flexible budget, and cash, like being okay with adjusting your spending as needed. Like, that is probably one of the most underrated aspects of financial planning, is being flexible with all of these things and not getting too precise. I think the more precise your plan has to be to fit the specific date or thing that you need, the range of outcomes for you is going to be, or the risk will go up, basically, the more precise you have to be.
If you make a concrete plan for this is what's going to happen in 15 years, just think about the last 15 years and all the world been crazy and how much you've changed the last 15 years. It's just going to break. It's not going to be right.
Exactly. Yeah. Rabih, I want to get you in here if you have any more thoughts on this before we hit a couple more things on this survey.
I like, so I do acknowledge the idea that you can't plan 50 years in the future, and we tell you should invest and not touch your investment for 15 years at the same time, right? It feels like contradictory, but throughout those 15 years, I think people assume that it's a one and done type of action. Like, I'm going to invest for 15 years and never touch it again. No, you are actually every single year looking at your investments and deciding whether you want to stay invested or not. It's not you're going to be making 15 different decisions, but it's going to happen that all these 15 decisions are going to be stay invested. It's not going to be sell out of the market until like maybe in year 15
changes.
So it's psychologically different, because if we are, as humans, it's so hard for us to know whether we're going to be the same person for 15 years. It's hard to convince ourselves to stay invested for 15 years. But this is, I think, a mental, like a behavioral bias. You're staying invested for 15 years, you're reviewing your investments every year, and the answer to whether you want to stay invested is the same. There's a difference.
It's a great point. One thing I'd say on this, it's interesting when I read through this and we're talking about this now, like my take generally on just retirement in general, I've actually kind of said this. I think the concept of the traditional retirement is actually a relatively new concept. It's actually like a post-World War II concept, but I already think it's outdated. Like, in my opinion, this idea that like, I'm going to work and grind to this specific date and then hang it up. Like,
and one day to the next, I'm done.
Exactly. And we talk to, this happens quite a bit in dentistry. We talk to dentists for various reasons where they're like, I want to, go all out, grind for the next 10 years. And then one day I'll live a good life. I think maybe it's just my personality and what I've seen and the experiences that I've had of just like, you got to find more of a balance and be okay with, again, more of that flexibility. But I will say, from my perspective right now, as I stand today, for me personally, have said, I'm never going to retire. Like, I'm saying that right now, but I guess I'm accepting the pushback this article and the survey is providing as being like, you have no idea. I have no clue, no clue. But as I stand today, that is my belief. I will always be doing something because I love what I do. Talk to me again in 5 years or 10 years. A couple other things as we finish this up that I thought some other threads we can pull in for just a second. This is not, there's some really positives that came out of this. So one thing that the survey mentioned was nearly 70% of those surveyed that are retired say their lifestyle is the same or even better than what they had envisioned. So it's actually like they're happier than they expected in retirement. But here's the key point. I thought this was so perfect. We got to hit this because we've talked about this so many times. Over half of those surveyed said that their overall spending is higher than anticipated, which we talk about all the time. If you are a dentist right now and you are mid-career and you're spending $15,000 a month, and you think, because we hear this, well, I'm going to plan for retirement, but I'm only going to spend half of that. No, you will not. If you're planning for retirement, you better go off of at least what you're spending now. Your lifestyle is going to be what it is now, or even more. It's going to even possibly increase. Jake, do you have thoughts on that from your experience?
Yeah, I mean, the main reason, which we've talked about before, is just inflation, right? This is this economic force that's going to happen. Just look at spending 10 years ago versus spending now. And the people who are planning to retire kind of in this time frame, they've really had to adjust their budgets then. It also happens too, where this is, my parents talk about this a lot, where we always think, oh, we'll pay off our mortgage, our kids will get older, we won't have all these expenses. Your kids are still going to want stuff, and you're going to want to go on vacations with them, or you're going to pay for their college. The kids their expenses just get to be bigger as you go along. You're still paying for them things, but you're never going to, I just feel like, we never see a drop, which again, is not a bad thing. Again, like the people, like, we just need a plan for that.
Into your plan. Yeah. We've said this before. It's really easy to be disciplined in the future. It's really easy to say you're going to work out in the future. It's really easy to say you're going to spend less in the future. No, you won't. Like, you are who you are. The lifestyle you have is going to be the lifestyle you're going to have, because you're not going to be a different person in 10 years, 15 years, 20 years. So I think keeping that in mind as you're planning is really, really critical, because if not, again, it comes down to that precision thing. If you're thinking, well, I spend this now, but I'm going to be more precise and more disciplined later, it's like, well, no, all you're doing is setting yourself up for failure. You got to plan for reality, basically. So, Rabih, any final thoughts from you on any of this?
Yeah, I'd like to add to what you and Jake were saying. I think on top of inflation and the lifestyle change is the fact that you're going to be earning 8 hours of your day with the free time, and living in a consumer-driven economy. If you revert to the default, you're going to be consuming in those extra 8 hours that you got, unless you find something that occupies you for 8 hours again, for you not to spend your money. But I notice it. I honestly notice it. Like,
it's like, yes, I'm not paying for my kids' sports teams anymore, but what's going to fill that void is we are going on 2 more trips per year, right? Something's going to fill that in what you want to do with your time.
So true. So true. Yeah. More time tends to be more spending for most people. So it's a great point. Guys, this was awesome. Tons of topics hit. I loved it. Hopefully it was helpful. We are going to finish up the show like we always do with plugging the Dentist Money Summit. We are so pumped. We're down to the wire here, guys. It's coming up. I can't believe we're already in May, and we're talking next month is the summit, which is kind of crazy to me. So excited. If you have any interest, any questions, please let us know. Check it out at dentistmoneysummit.com. It's going to be June 21st and 22nd in Park City. We cannot wait. It's going to be an amazing event. But for now, that is our 2 cents. Thanks everyone for listening. Have a great weekend. Till next time. Bye-bye.